Hello, hello, test. There we go. Resume. Okay, recording. Okay, welcome to the Investing Advantage podcast. Today, I'm joined by my special guest, Justin Smith from Hawkeye Wealth. Justin is a guest that I've had conversations with in the past. I'm very excited to have him on. And his firm, and I'll let Justin kind of take this away in a second, but he really specializes in kind of helping high net worth individuals that have money and want to invest in commercial real estate. Now, I don't want to put words in your mouth, but maybe you can kind of tell me a little bit more about what Hawkeye does. And then maybe even just start off, like, how did you get into this business, Justin?
Yeah, so we work in private equity real estate. And as you alluded to, we help individuals get involved in private commercial deals. And really for us, it's a three-pronged process. The first is to find strategies that we like in commercial real estate. Not all strategies right now are created equal, and across the market cycle too, you might have a strategy that's in or out of favor, right? So step one is to create a strategy, find the strategies that we like. And then number two is to go and identify groups that we believe are the best at executing on those strategies, which I personally believe is the most important part of any due diligence, is making sure you're working with the right folks. And then we're usually very slow on that process. We say the due diligence on the deals can be done in days and weeks, but due diligence on the people is months and years, because we view that as the highest risk part of Hawkeye Wealth's business. So we're very slow on who we choose to do business with. But once we found those groups then start to send deals your way. Then our job on the third prong is to go and vet the deals, do due diligence on the deals. And once it passes that, we go and introduce it to our investor network. So long story short, that's what we do. We find the strategies, find the groups, and then we vet the deals.
Okay, and I want to go into those deeper. I'm curious, like, how did you get into this world of commercial real estate? Because it's kind of an obscure, like commercial real estate's somewhat small, and then the capital raising is even a sub niche, if you will. So what's your background? How did you kind of get introduced to this?
Yeah, well, about a decade ago here in Vancouver, I just finished my MBA. Probably like many MBAs, I thought that the employers were going to come banging down my door, ready to pay me six figures, and that was probably the biggest education I got from my MBAs. that wasn't the case, and so it took me a little while actually to get a job, and it was one of those 9-to-5 jobs where I felt my soul slowly getting sucked away every day that I went to work. So I was kind of keeping an eye on what else was going on out there. And one day, my landlord invited me to a conference, a real estate conference. He looked like he had quite a bit of success. So I said, why not, right? And so listened to this conference and a number of great speakers. I was blown away that real estate could attract, that topic could attract so many people. I think around 700 people in the audience or so at this particular conference. And the speakers blew me away. One in particular that I was very impressed with. I said, well, why not? Why not go talk to this guy afterwards? And 2 weeks later, I quit my job and got into the real estate pre-sales business.
Nice. That's how it all kind of, your introduction into the world of commercial real estate.
Yeah, well, it wasn't even commercial at that stage. It was residential pre-sales.
Okay.
And it was a struggle. It was a struggle. Anybody that gets into these types of business, whether it's raising capital, any type of sales oriented business, can be a struggle at the beginning. And for me, that was definitely the case. Netflix had actually just come out at the time. So if you're not, if you don't have the oversight anymore, and then you're at home, Netflix, it wasn't good. My wife was working full time, and she was the one that allowed me to do this business, right? And she'd come home and I'd probably, I don't know how intentional it was. Maybe it was let on that I'd done a little bit more work than I'd really done that day. She was slaving away, and one day she just had it, and she said, "Justin, this isn't working. You got to go back and get a job."
Right.
I don't know. I said, no, I can't do it. I froze up because I'd just come from that, and I just knew it wasn't for me, but she was right. What could I argue with, right? Mm-hmm. And anyways, she said, you got to get a job. And I said, well, I'll tell you what, honey, if if I don't make $10,000 in commissions this month, I'll go back and get a job.
Yeah.
And she said, okay. And then I thought, oh man, the pressure goes off, and then the pressure comes on again. And I said, well, why didn't I say $5,000 or something like that? She would have been happy with it, right? But you get to work and raised $10,035 that month. So about $36 away from not being on the podcast. But that was my introduction into the business, and slowly began adding clients and then adding properties as well. Some of the properties that my clients were buying, I also started buying myself. And I realized that, for every dollar I was making in commissions, my clients were making a lot more money than I was on the real estate. So why not go down that road? And then eventually that led to commercial real estate. And about 5-6 years ago now, doing multifamily down in the US. So that's kind of the origin for me.
Nice. No, that, I always find it just really fascinating how people kind of get introduced. And I think how valuable it is to have a supportive spouse, right? Because I know even in my own journey, my wife making sure that pushing on me when I needed to, and then supporting me to really, because let's face it, this is not a business that you just set up one day and overnight you're successful, right? I mean, it takes time. If it was as easy as people made it out to, I think that, there would be thousands of us, and there's it's just not the case. So
yeah, well, the lesson you got to do the work.
Yeah,
you got to do the work. If you don't do A, you're not going to get B. And the journey is what is A.
Yes.
And then do it, and then it's wait for B to happen, right? And if B doesn't happen, then you're either not doing A or you've got the wrong A. So I'm with you. It's nothing wrong with a little healthy pressure. My wife still gives me some as required. And you got to do the work. Those are the big lessons for me there.
I agree. So let's talk about I'd be very curious, how do you vet, I don't know if you want to go after, how do you vet your deals or how do you vet your groups? I think because groups is more important. Why don't we maybe talk a little bit about that? Because I think the audience that would be listening to this, whether they invest passively or maybe even through a group like yourself, I think that is so key on how you really understand who you're partnering or aligning with.
Yeah. Well, we're in a pretty fortunate situation where a lot of groups are reaching out to us as well with their opportunities here. And we get contacted by enough that, as you kind of alluded to, it's a bit easier for us to start with our due diligence on the people. And of course, that due diligence on the people always begins with an opening conversation or a coffee. And for us, it's as simple as if we don't get a really good feeling in that first or second meeting, done.
Yeah.
Well, there's far too many great groups to work with in this world to waste time on that. And what are the red flags or yellow flags that we're looking for there? Too much ego is a big one for me in this business. They're talking about themselves a lot and how awesome they are, and how they've never done anything bad in their life. For me, it's a non-starter. Too much ego. I can't do it. And these are some people that, if you believe what they're telling you at face value, might be some very successful people. They talk about the dollar figures they're throwing out there, tens, hundreds of millions of dollars. But me personally, that's an immediate no, regardless of how big they are. So I like enjoying who I work with, and too much ego. It's a straight no. Are they relationship first people? Yeah. That's another thing I'm looking at here. I've got a number of groups. One thing I'll sometimes say when I get reached out to a group, and maybe some sponsors will be watching this and they'll know not to do this when they call me with their deals. Yeah. But one thing I also do is say, you want to know what here? Because they'll always come. You'll usually come deal first. They'll say, hey, Justin, saw your group here at this conference or saw your website. We do this. Check out our deal. And my first response usually goes something like, that's a nice deal. But if you're looking for somebody that you need money for right away, we're not really your group. But if you'd like to go and have a coffee or have an introductory conversation, and then, we can explore what might happen a year or two down the road. And I'll use the words a year or two.
Yep.
Because I want them to know that we're slow with the people.
Yep.
And you'd be amazed at how many people and issuers out there just, thank you, but no thanks. My problem needs solved right now. You can't solve my today's problem. I'm not going to plant a seed for tomorrow. And for me, it's, that shows that they're not relationship first, and it shows that they're not long-term thinkers.
Yeah.
A long-term thinker is going to be willing to plant seeds for tomorrow.
Absolutely.
And so, that filters a lot of people out as well. A lot of our job is to filter out the people. Do they start with how much they're going to pay me and how successful I'm going to be with this? Because if that's their line, Justin, you are going to be filthy rich if we do this deal. That's nice, but clients usually come first.
Yes.
So I don't want to hear about how we're going to win. I want to hear how the deal is going to win and the clients are going to win. If the clients win, I win.
Yes.
Doing what I do for many decades. So if they come in talking about how filthy rich I'm going to be, it's basically a hard no. So a few of the things that we do to vet the groups, and then ideally too, how long have they been around? What's their track record, and have they gone through a downturn? Yeah. So if you want to be able to know that when things aren't going as well as they should, that you've got a group that can continue to communicate, that goes and works through it and comes out the other side. Because I think most real estate assets, if you're in a decent market, you can hold on if you structure the deal right and you've got the right people. And if you get groups that come out stronger through downturns, because it makes you better. Yes. And you being in Calgary probably know this better than most right now. You're really separating that, not a 21st century term, but the men from the boys, or the whatever the female equivalent is to it.
Yeah. I had a conversation with my brother-in-law the other day, and he's in the development business, and we were talking, and the conversation was something along the lines of, Shane, if you can make money in this market, and we've had a couple of good successes, but I got to tell you, we're working way harder. You've got to look at a lot more deals. You've got to be a lot more careful. And, but he said, if you can make money in this market, you can make money in most markets, right? Because it's arguable, are we flat? Are we declining? I mean, different asset classes, different locations. But no, I absolutely, like, there are so many things. And this is why I think we were having such a, prior to us even getting on the phone, we talked a month ago or so. And I was like, I think it'd be cool to have you on the podcast, because we just have a lot of similar principles, right? I mean, relationships, track record, no ego, someone that just focuses on, all the amazing deals they've done and they've never made a mistake. Like, to me, I'm very cautious of that, number one. In terms of relationships, even for investors that come into my own deals, I tell them, I'm like, look, I've got guys that have been with me for 10 years. They get the first view of my opportunities. I'm always expanding, but just because someone has money does not necessarily mean that they're going to be an investor in deals I have, or I'm sure even just how you raise your money, right? I mean, it's relationship, and you want to make sure you're bringing in people that have similar values and beliefs and principles. And
yes. And it goes the other way, because, we talk a lot about vetting issuers, right? Making sure we're getting the right groups to work with.
Yes.
Well, it really helps if you're the right group to work with too. You want to be, once you find a winner, and it's funny because we talked a little bit about this before hopping on the podcast today, that, oftentimes we'll have groups approaching us. Oftentimes we found some of the best groups, they don't actually need my clients' money, especially in this market. We've had a very long and strong cycle. I think raising money today is easier than it's ever been. It doesn't mean necessarily, it's almost too easy right now. It's almost scary easy. People don't vet deals like they used to. But my point is this: a lot of the best groups don't need your money. And if they don't need your money, how are you going and doing things right for them as well, right? Are you working with, Are you working with super needy clients that are gonna, if there's a little bit of turbulence along the way, that they're gonna cry foul and say, oh, every once in a while I'll hear someone say, oh, you promised me X%. And then I'll be like, there's a lot of things in this business I don't know. There's one thing in this business I do know, and that's that I never promised anybody anything.
Yeah. You never promise and you never guarantee.
No, yeah, it's just words you don't use in this,
exactly.
this industry, right? And so you need to have the right clients, and you need to be the right client for the issuers as well. It's not just you finding them; it's them. It's being right for them as well as them being right for you.
Yeah. So let's let's talk about some of the asset classes that you like. I mean, you alluded to the fact that you're in the U.S. I have an idea of the type of deals that you're looking at down there because we've had conversations on this. But I think most people probably wouldn't be aware of the type of asset classes you like, and maybe asset classes that you're not as comfortable with.
Yeah, we're still very heavy on multifamily in the U.S. especially in the mostly in the southern U.S. We'll talk Phoenix, Vegas, Atlanta, Houston, Dallas. Some of the markets that we're down in, and I'm traveling down to pretty often. Really like multifamily. It tends to, the biggest reason is it's tended to fare better than most asset classes through downturns. And that's becoming more and more important as we get later into the cycle.
Yes.
And so continue to like multifamily. I also like the US due to the fact that the name of the game in multifamily right now, for the most part at least, is value add. So you need to find assets that have been under operated and mismanaged. And when you can go do those, of course, the magic of commercial real estate is you can dictate the value of that real estate by influencing the net operating income. So the US just has a lot more markets and a lot more buildings to choose from than Canada does. So we like it. We think there's a lot of opportunity in the value add space. And then the last part I'd say about particularly why we like the US, there are still areas where the laws, I'm not even going to use the word favorable to landlords. I'm just going to say they're fair.
Yeah.
Because it's not the case. I think in a lot of markets right now, they're leaning very much towards the tenants, and I think maybe to the short-term benefit of the tenants, maybe not, but certainly to the long-term detriment of everyone, including the tenants, as assets aren't maintained the way they should be. So the U.S. I think has a number of markets still that I think have favorable tenancy laws.
Nice. When you are there structures in terms of how these the principals or groups that approach you, are there structures that you look for as it relates to splits or fees, or is there kind of is there, I don't know if I wouldn't use the word typical, but what structures do you like to see, if you will, that you're like, what, I can tell this group knows what they're doing?
Yeah, I would say I like to follow a couple of principles. Number one, is it easy enough to understand? The more complex a structure gets, it's going to go through this entity, which is owned by this entity, which is owned by this entity, which, it's got this shareholder in the Caymans. And the second I start seeing any of that stuff, it's just a no. It's a no for me. It's, I don't necessarily, I didn't go to law school, but even if I go and hand the docs to someone that's been to law school, by the time my lawyer's done with it, I'm going to go have a bill that I don't want to look at. And I just, maybe it's okay, but maybe it's not. I just don't know. It's an uncertainty. So complexity of the structures. And then it's going to sound simple, but I think it's important. Does it show an intent to be fair?
Yes.
And there's a couple of different things that we're looking for on that. What percentage of the fees are independent of performance of the deal? If they're just taking a ton of money up front and it's not as much related to the performance of the deal, then I'd say that's a strike against fairness for an opportunity, right? Are the general partners investing in the deal themselves? There's a lot of deals where they don't, right? And you'd like to see sizable checks if possible. And it's not necessarily a deal breaker, because a lot of general partners do a lot of different deals, and to go into every one, it's like a client asking me if I'm in every deal, and the answer is no. Sometimes I'm in. Would I be in every deal? Yes, I would never put a deal out to my clients that I wouldn't invest in personally.
Yeah.
And I found the best way to do that is to actually invest in them personally. So, yeah. But there's occasions where it doesn't make sense for me to invest, right?
Yes.
Probably have a sizable tax bill coming up in 2020. Do I want, yeah, what am I going to do? We're people too, right? But I'd say that's another big part of it. I would also say, are they fully transparent with the fees?
Yes.
Because you'll find it sometimes, like if you have to go and look in 3 or 4 different places to get the full scope of what they're charging you to operate the deal,
yes,
you're having to look too hard.
Yep. Totally agree.
You should be able to see this in one spot. Yeah. And it should be reasonably, it should be pretty easy to find. And if you have to go and dig into page 53 of the LPA or wherever until you're finding fees, then the problem isn't fees. Of course, I get paid a fee. That's how I make money. Obviously, I have no problem with fees. But you have 2 things here. Are you getting value for the fees charged?
Yes.
Is there alignment on the fees?
Yes.
And is there transparency around the fees? And I'd say the third is just as big as the first 2, because if you've got a lack of transparency, you don't just have a fee problem. You have a potential character problem. Yeah. And as I started with groups that I work with, groups that I don't work with, it's, do not pass go, do not collect $200. You just, you throw them out, right?
Yeah. It's shocking when I'll have people sometimes show me when they're trying to raise money, and they've got these complex waterfalls and how they're, getting fees here and there. But if, and it's just like, and I've been at this for a while, and I'm thinking, you're having a difficult time explaining it to me. And I understand this. So when you go out and just from pure raising capital, like, you're going to confuse an investor to the point where they will probably just, a confused mind says no. Right. And so,
yes.
So from that perspective, and then I think the other part of it is just from like an alignment. I mean, that was the word you used, and that's like a key word that I use too, which is like, I want the investors that come into my deals to feel like we're all aligned. Like, if I win, then they win, or if they win, then I win. Like, it's it can't be the GP just wins regardless because they're feeing this deal to death, and hopefully the deal works out. I mean, that's, unfortunately, you see that in some situations, but
you don't want to be in a situation where the investors feel like the pain that they're feeling is not being felt.
Correct.
By the GP, because if that feeling becomes prevalent in your investor base, you're going to have a hard time when it comes to raise for your next deals.
That's right. Yeah. You know what? That is I like that. I like that a lot. Maybe on that point, I know that we didn't really discuss this, but is there advice that you would give to someone that is going out and looking to be a principal in a deal and raise capital? And we don't have to, we're not lawyers, we're not accountants. So any advice, this is purely 2 guys having a conversation that happen to have done this for the last 10 plus years. We've got some reasonable success, but this is just some ideas. Okay.
So yeah, you're right. I'll start with that. Go talk to a securities lawyer before before you're going to raise any capital, to make sure there are a number of rules involved, and we want to make sure that you're squeaky clean when you're going and raising funds. Well, where would I start with it? If you're just getting started out, where the rubber really meets the road is talking to people. And when I first started this business, you would go and for me, it would happen in waves, right? I would sell nothing, and then you get a little confidence, and then you'd be like, yeah, this is a good deal. And then all of a sudden, you're confident sharing it with everybody that you know, and you go and you have a successful raise and a successful close, and you're excited, and then that dies down, and then you're like, oh, what just happened? I've got nothing to do again. And then you're back on the Netflix. And then you got to go and lift yourself out of that again. And it becomes very, very cyclical. And,
yes.
And one thing that really helped me and almost immediately doubled the amount of funds raised for me was a very simple rule. And that rule was 15 calls and 5 conversations. Now, this was one, I'd like to say this was, this came from me. This came from my business coach that I spend many, many, many thousands of dollars every year to tell me to do these things. But I would go and make sure that I had made 15 dial outs every day. And of those 15 dial outs, I had to connect with at least 5 people. If I didn't meet either of those 2 things, let's say I'd had 5 conversations, but there were only 13 dial outs, I'd have to keep going until I got 15. If I had 15 dial outs, but only 3 conversations, keep going until I've had 5 conversations. So you have to meet those 2 thresholds. And then I would report back to my business coach every day.
Yes.
On whether I did that or not. And that unlocked a whole new world for me. Because what happens is, it sounds simple, but it really was the one thing at that stage for me. Because what happens is you talk to Bob and Joan, and they say, oh, that's great. That sounds really interesting, Justin. Send me some information. And then you hang up the phone and you say, well, what am I going to send Bob and Joan?
Yeah.
I better have some marketing. So you go and you make sure that you've got the proper marketing packages and everything put together that way. And then you go and if Bob and Joan say, oh, that's interesting, what do you have to show me? Well, I don't really have a deal to show them right now. I'd better go find a deal, right? And it all starts with talking to someone. And if you're continuously talking to people in this business, and I find to hold yourself accountable to it, the cycles kind of go away. You're just, the consistency with which you can raise capital goes up. So I'd say get off these cycles and make sure you're talking to people on a daily basis.
Yes.
About doing deals. Let's say if there's one thing that I've learned in this business, and it's not revolutionary, it's nothing that you couldn't be heard elsewhere, but I just like to restate it here. Yes. It is by far the most important thing for principals or anybody that's going to be out there looking to raise capital. And then when you are talking with people, yes, connect with the people. They care. They're vetting you before they vet the deal.
That's right.
So make sure they know who you are.
Yes.
Usually you open your podcasts up like this. Who's Justin Smith, right? Yeah. And, to get a little bit of a story so that there's a little bit of a context for the information that's coming out of my mouth, right? It's the same thing when you're talking to prospects. So make sure you connect, make sure you're having fun. I remember one time it was, I just finished a conference and whenever you finish a conference and people give you their contact information to get in touch with them afterwards.
Yes.
You always have this game of guessing, what that email actually says. Is this an E or an A? And, everyone played this game before, Shane.
Yeah.
So you're trying to guess what it is. And I'm like, I can't get this email for the life of me. And it's probably better for me to call him anyways. So I call this guy, and I probably took a little bit of a risk, but I like to have fun, and I've got a little bit of a joking nature, I suppose.
Yes.
And he picks up the phone and he says, hello? And I'm like, hi, and I introduce myself. He's like, oh, yes. And then I ask, are you a doctor?
Are you a what?
Are you a doctor?
Yeah.
And there's this awkward pause on the phone. And he says, yes. Why? And I don't know what possessed me, but I'm like, possessed me to say this, but I was like, that is some of the ugliest writing I've ever ever seen in my life. And I'm like, this can go one of 2 ways, right?
Yeah.
And long story short, it went well. Ends up being, had some fun along the way, and get to share a story on your podcast. So,
I love that. You know what? You're right, because this is a relationship business, right? And relationships, they take time. They're built mainly. I mean, face to face is ideal. Phone next, and you just kind of go down the sequence, right? And I think my own experience is, look, social media and online is wonderful because you can kind of build a broader audience, if you will. But at the end of the day, it comes down to this. I mean, that's why I enjoy having these podcasts with face to face, right? It's just a little more interesting than if we were just on the telephone. So
totally. And one other thing I would say too, because I think we were talking about this earlier, we could do many segments on raising.
Yes.
Well, there's a lot of intricacies to it. But one big framework as well that I found very helpful, that might be helpful for your audience.
Yeah.
I call it the 5-question framework. Everybody's got a certain number of questions, and I picked the number 5, but 5 is arbitrary. They might have 4 questions. They might have 7 questions. Everyone's got a number of questions that they need answered.
Yes.
Before they're going to come into a deal.
Yes.
And your job in the world is to answer them in sequence. They ask you question number 1. If you answer question number 1 well enough, you get the privilege of hearing question number 2.
Right.
If you answer question number 2 well enough, you get the privilege of answering question number 3. And if any stage you answer a question wrong, the chances that you're going to do that deal go pretty close to 0. I've seen them come out, but goes pretty close to 0. So what I would say is, please go and make a list of the most common questions that are asked to you. Yes. And anybody that's going to be raising funds for a deal, go and write down at least 3 strong points.
Yes.
To answer each of those questions. Rehearse those points. Become a master of those points, because everyone's going to ask. Everyone sees the world through their own lens, so everyone's going to ask a different questions. The accountant is going to ask a different question from the contractor. The contractor is going to come and maybe oh, really? Do you use 2x4s or 2x6s? And these kind of questions, right? The accountant is going to start giving you tax questions. So maybe there's a total pool of maybe 30, 40, 50 questions per deal.
Yeah. Max.
And that's like, after you get past 10 questions, they start getting more obscure. Most of them are you're nodding. You've done this before, Shane. So that's the other thing that was very helpful to me, is to understand this framework and then make sure that I do the work to make sure I'm answering those questions, not just okay.
Yes.
But answering with absolute confidence and clarity for the client. And if you do it, you'll find a way to raise money if you've got a good deal.
Yeah, I love it. Well, you know what? I think just in the spirit of our time, we should probably wrap up. I want to make sure that we give a handoff to where people can find more about you, and because it's gone so fast, it would be kind of neat to have maybe another conversation where we could go deeper into your strategies as it relates to raising money, or something to that effect. As long as you're comfortable sharing some of your not too proprietary, because that's your secret sauce. So I get it. But you could give maybe some helpful strategies to people that are kind of new to this game. But
totally, the one cool part, Shane, the one cool part about the real estate investment space I found is that people are very willing to share, and totally. I've had a lot given to me. Nothing that I've shared with you today is something that someone else hasn't shared with me at some point, right? And so for me to go and not give that back would be pretty silly in my mind. Even you having me on the podcast today, I think there's opportunities to collaborate, but it could be, maybe there's opportunities to compete too, but neither of us come at it from that.
We're not scarcity minded. There's lots of deals, and exactly. Yeah.
So totally, it would be happy to come back and share what I know on the fundraising side. And if somebody wants to come and find a little bit more about what we're doing, they can do it at hawkeyewealth.com. Yeah. That's hawkeyewealth.com. You can look up Justin Smith Hawkeye Wealth on Google. That'll get you there. And if you want to come, we've got the private equity investment guide. If you're just looking into the space and wanting to learn a little bit, you can download it there at the site, or you can reach out to me on the contact information part of the site there. So
Perfect. Well, I'll have a link to your website, and then make sure I get a link to that report so that people can go and get that too. I think that'd be extremely valuable. So,
Wonderful.
yeah, Justin, I really appreciate this. I had a lot of fun. My cheeks are kind of hurting. If you could see, I was laughing and smiling quite a bit on this show. So it was great.
Really appreciate it, Shane. Take care.
Okay. Thank you. Bye-bye.
Bye.